Well, so let's start with that, if you can explain, because this looks like a lot of panic.
Sure.
Should we all be panicking? Can you explain this in layman's terms?
So on Friday of last week, the big news broke with the unemployment report that we got. It comes out monthly from the Bureau of Labor Statistics, and it's backwards looking in nature. So it was looking at unemployment in the month of July. And what it found was that the unemployment rate creeped up again for the fourth month in a row. And now we've gone from this point where a year ago, so July in 2023, unemployment was sitting all the way down at 3.5%, which was pretty abnormally low, right? We all remember the days of really, really tight labor market of just a couple of years ago when everybody was getting multiple job offers and it was really easy to find work. We've now come up to 4.3%. In and of itself, 4.3% historically not a really high unemployment rate, but what has happened is we've crossed what's called the Somm rule threshold. And to oversimplify and simplify things here a little bit and summarize them, Claudia Somm, a former Federal Reserve economist, looked back at previous recessions all through modern history and found that basically when unemployment rises by more than 0.5% in a 12-month period, and she uses some 3-month averages there, but when that happens, in every single case in modern history in the United States, it has been coinciding with a recession, let's call it. And there's been no false positives, unlike some of the other traditional recession indicators that are out there. And so people looked at that and said, and I think appropriately are saying now, hey, the risk of recession is now higher based on where unemployment, the trend on unemployment has been going over the last few months. And as such, that leads to risks for stocks, as we're seeing playing out over the last few days in stock markets.
So are there any benchmarks to look for that could change the way this is going?
Yeah, well, I mean, first of all, I think it's important to keep everything in context. We are seeing some big swings in markets, today, Friday, even, really since mid-July is when things kind of topped out. But with today's trading, depending on where things close, we're about 7.5% from all-time highs. That is, again, a big swing in a few days, and if you're looking at your 401k, I recognize, dollar-wise, that's not fun, but we have to recognize that, according to some data from Ritholtz Wealth Management, one of our competitors, that happens in 94% of calendar years where you have a stock market correction of 5 or more percent. It's fairly normal. In fact, in about 2/3 of years, you have a 10% correction. We're not even there yet. And so this isn't to say that things will get better immediately. They may get worse before they get better. My only point is that, unfortunately, this isn't some bug in the system. This is just kind of normal for equity markets, and it's just feeling weird because we didn't have it in 2023.
So if it's happened before, if it's normal, how long does it normally go on?
No answer there. There is no real answer, right? You think back to the Great Recession of 2008, which I am not saying that we are in, but it took a good 1.5 years for equity markets to bottom. There were a lot of false positives where they went down and then back up and then back down again, and ultimately, we resulted in very high unemployment and a very painful period of time. And I don't think anybody's saying that's where we're headed this time, but there is no standard. There is no standard, and I think the important thing to be asking oneself at this point, assuming you're not a hedge fund manager with billions of dollars, is, have I thought about this type of event and how my portfolio is supposed to react to it, right? If I'm working with a professional, have they addressed the possibility of recession and what they've done to design my portfolio for it? If I'm doing it on my own, was I anticipating something like this in the future? And in the most important case where people are taking money out of their own retirement funds instead of putting new money in, it's where is that next income source going to come from? Do I know ahead of time what I am doing in this type of environment? Because unfortunately, even the very best market analysts out there almost never call the top and the bottom properly, and it's really tough to know which one we're headed for next.
Anything we can do to protect our investment, our money?
Like I said, I think anything you do at this stage should be taking a critical look at what you already have. The time to be preparing for the next recession was when markets were all-time highs. And I hate to say it that way, like, be thinking about, take a look. And if you can't answer that question, right, if you can't answer, what am I doing or what have I already done to prepare for a recession, then that's a good reason to go seek help and take a second look. But I think for a lot of different reasons, people can allow emotions to play into their investments. And that's plenty of good places to have emotions. Investing is usually not one of them. And, I get asked a lot about the political situation. Obviously, it's an election year. There have been a lot of firsts over the last 5-6 weeks, or just a lot of abnormal things in politics between assassination attempt and a new person on the Democratic ticket. I would just say that the possibility of higher jitters because of that exists, and you really need to try and check them at the door when you're talking about your financial future.
So, and for people who might be saying, oh, there's some bargains out there if prices are falling, is that acting with your emotions to sort of panic and start
Again,
selling and buying
not
things?
necessarily, just remember the game that you're playing, right? Like, if you've never done that before and you're just suddenly picking up on it now, then great. If you're a long-term investor who has never altered their allocation before, I would always ask myself, what advantage do I have over everyone else out there? And if you think you really do, then of course there can be opportunities, but I would be really careful and really check yourself to say, what am I attempting to accomplish here, and what experience or history do I have with trying to take advantage of this? Because there's nothing to say it can't continue further down. And like I said, it wouldn't be all that abnormal if it did. 10% market corrections, which is not where we are yet, happen about 2/3 of the years looking back since the 1920s. Like, it's very common to have markets go down further than we already have over the last couple of days.
So if you were planning on retiring, like, this week or something, what do you do?
It's probably stressful. And I would go back to that question of, do I feel prepared for this specific type of event? Because I think most money managers out there would tell you that, yeah, we prepare for this type of event because we can't necessarily forecast when it's going to happen. And if you don't feel prepared for it, then maybe seek professional help, maybe go talk to somebody. But if you are, then oftentimes the best thing to do, close that web browser, turn it off for a few minutes, and just go focus on something else for a little bit if you can. Because again, when emotions get involved, it oftentimes leads to bad things.
Yeah, that was my next question was going to be, what about those people who are not ready to, who aren't even close?
Sure.
Would you say just don't even look?
In many cases, yeah. Again, with that caveat that you should have an answer to what you were planning to do in this type of event, but you might be able to look at it as buying things on sale if it continues in this direction. And so, nothing about this looks to, I think, anybody out there like, the world is ending. We are going through a point of economic pain. And quite honestly, if markets weren't reacting this way to the unemployment report that we got on Friday, I'd be more concerned. It's a pretty natural reaction to say, okay, that possibility of recession is now elevated, and so things need to reprice because of that inherent risk in markets now.
All right, one more thing. A lot of people look at interest rates.
Sure.
If you're looking to buy a house, get a loan for something, is that going to change the market?
I mean, already has in some cases. According to Mortgage News Daily today, the average 30-year fixed-rate mortgage is down below 6.4%. I know that doesn't sound terribly low in my own context or any context of the last decade, but we were up over 7% 1 month ago. So you're already seeing, the Federal Reserve has not acted yet. Jerome Powell hasn't come out with his purple tie and cut interest rates to this point. But markets are doing some of that work for him, and you're already seeing interest rates come down pretty substantially. So you're starting to see that in interest rates. I know it feels a little bit tougher here in New England, where inventory levels are just not moving at all. But should you see this continue, I would expect interest rates to come down further, and perhaps that could lead to a little bit of a healthier housing market.